Today, we're breaking down borrowing against Bitcoin. Smart strategy or fastest way to lose your stack? Simplified. Welcome to Bitcoin Bytes HQ, simple Bitcoin explainers. This is educational content only, not financial advice. Let's go. Borrowing against Bitcoin means using your BTC as collateral to unlock cash without selling your holdings. Instead of converting Bitcoin into dollars and potentially triggering capital gains taxes, you deposit your Bitcoin with a lender who then issues a loan based on a percentage of its current market value. That percentage is called the loan-to-value ratio, or LTV. If you deposit $100,000 worth of Bitcoin and borrow $30,000, your LTV sits at 30%. The lower the ratio, the more protection you have against volatility. The higher it climbs, the closer you move toward a margin call. What makes LTV so important is how quickly it changes when Bitcoin's price moves. LTV is not a fixed number, it floats with the market. If Bitcoin drops 20%, your collateral value drops with it, and your LTV automatically rises even though you didn't borrow more. For example, if you borrowed $30,000 against $100,000 of Bitcoin at 30% LTV, and Bitcoin falls to $70,000 in value, your LTV suddenly jumps above 40% without any additional action. This floating nature is what makes Bitcoin-backed loans dynamic rather than static. So why would someone choose this strategy? The first reason is tax efficiency. In many jurisdictions, selling Bitcoin creates a taxable event because you've realized a gain. Borrowing against it, however, does not typically trigger taxes since ownership hasn't changed. You gain liquidity while preserving the asset. This is why the strategy is often framed as banking like the wealthy, because affluent investors commonly borrow against appreciating assets rather than liquidating them. The second appeal is retaining upside exposure. If Bitcoin appreciates significantly over time, you continue participating in that growth because your stack remains intact. You gain access to capital today while maintaining long-term conviction in the asset. The third reason is capital flexibility. Borrowing against Bitcoin can provide funds for business expansion, property renovation, strategic investments, or temporary liquidity needs. When borrowed funds are deployed into opportunities that generate additional income or long-term value, this is what is often called productive debt that supports growth rather than consumption. One more advanced concept is a feedback loop strategy. In this approach, a borrower takes a loan against Bitcoin and invests the proceeds into yield-producing instruments, such as dividend-paying funds. Dividends from those investments are then used to purchase more Bitcoin. That additional Bitcoin is added back as collateral, lowering the LTV ratio or increasing borrowing capacity. Over time, this can create a compounding effect where collateral grows while generating additional income. On paper, this structure appears efficient and mathematically compelling, but embedded within that design is leverage. Once borrowed capital is reinvested into another asset, the strategy depends on multiple variables moving in harmony: Bitcoin's price, interest rates, yield stability, and market liquidity. There is also a time horizon consideration. Bitcoin is often held for the long term, while loans create short-term obligations. This mismatch can force decisions that conflict with a long-term investment thesis if price moves suddenly. The entire strategy can work beautifully in stable or rising markets, but it is tested the moment prices begin to fall. Now that we've unpacked why people borrow against Bitcoin, let's examine what happens when volatility enters the picture. The primary risk of borrowing against Bitcoin comes from the combination of volatility and instant liquidity. Bitcoin trades globally 24 hours a day, 7 days a week, and its price can move dramatically in short periods of time. A 10% swing in a single day is not unusual, and during periods of stress, declines of 20 to 30% or more can happen quickly. Because Bitcoin is highly liquid, lenders can act immediately to protect their capital. If the price drops and your loan-to-value ratio rises above the lender's threshold, a margin call is triggered. You must either add additional Bitcoin as collateral or repay part of the loan to restore the agreed ratio. If you cannot respond in time, the lender has the contractual right to liquidate your Bitcoin to recover the loaned funds. This can happen within 24 to 48 hours. Unlike real estate, there is no extended negotiation process and no months-long refinancing window. Liquidation can be immediate, which creates the risk of becoming a forced seller during a market downturn. In severe drawdowns or black swan events, cascading liquidations can amplify price declines as leveraged positions unwind simultaneously. Another critical factor is the cost of capital. While ultra-wealthy individuals may secure loans at relatively low single-digit interest rates through private banking relationships, retail Bitcoin-backed loans often carry double-digit rates. If you're paying 10 to 15% annually, any strategy funded by that loan must outperform that rate just to break even. In a feedback loop structure, this means dividend yields must remain consistent and strong. If yields decline, interest rates increase, or volatility compresses returns, the margin of safety narrows quickly. Buffer becomes the defining variable. Wealthy borrowers typically leverage only a small fraction of their total net worth, preserving flexibility if markets decline. Retail investors sometimes pledge a significant portion of their Bitcoin holdings as collateral. If a margin call arrives and no additional liquidity is available, liquidation becomes unavoidable. Behavioral risk is also critical. Margin calls rarely happen during calm markets. They arrive during fear, when decision-making is clouded by stress. Hesitation or delayed action can have costly consequences, even for disciplined investors. Counterparty and custody risk further complicates matters. Centralized platforms often hold the collateral. Operational, financial, or regulatory problems at the lender can temporarily or permanently restrict access to your Bitcoin, independent of your LTV. Finally, leverage amplifies outcomes symmetrically. Gains feel controlled in rising markets, but losses accelerate in falling markets, and the emotional impact is rarely symmetrical with the mathematics. This is why disciplined risk management is essential. Borrow against only a small percentage of total holdings, maintain excess collateral, keep liquid reserves available to respond immediately to margin calls. Stress test every assumption by modeling scenarios where Bitcoin drops 50%, interest rates double, or yield is cut in half. A simple next step could be opening a spreadsheet and running your own stress tests. Assume a conservative LTV, simulate a major drawdown, and determine whether you could comfortably add collateral if required. Seeing the numbers clearly often changes how aggressive a strategy feels. Borrowing against Bitcoin can function as a strategic liquidity tool when used conservatively and with substantial buffers. But when executed aggressively or without contingency planning, it can transform a long-term holder into a forced seller at precisely the wrong time. That's borrowing against Bitcoin. Smart strategy or fastest way to lose your stack. Simplified. If this helped, like, share, and subscribe for more Bitcoin explainers. Drop your biggest takeaway in the comments. I'd love to hear your thoughts. See you in the next one. Thanks.